Hi, I'm Prashant Joshi, Professor of Finance at St. Martin's University, and I welcome you to my presentation on net present value and other investment criteria. Here we will learn of various capital budgeting techniques. While these slides primarily concentrate on the mathematical aspects of project analysis, it is essential that you also learn the advantages, disadvantages, and limitations of each of the methods presented. As always, review the abbreviations before starting the problems. Let's begin with the problem. Projects that increase wealth should be accepted. How does the net present value determine if a project creates wealth? And this is the net present value being estimated using mathematical equation, and it is NPV, which is pronounced as the letter NPV, is the combined present value of each of the individual cash flows related to a particular project. So this is the present value of cash flows in each year. The project shown has an NPV of $4544.94 in today's dollar, given the estimated cash flows at 11% rate of return. So this is a discounting factor. This project should be accepted based on the net present value decision rule, which states that you should accept project if the NPV is positive. You can also accept projects that have a zero NPV, as a zero NPV indicates that you are earning exactly your required rate of return. Projects with negative NPV will decrease the firm's value and should be rejected. If you are using financial calculator, this is how the value should be inserted on the financial calculator to compute NPV. I'll show you how Excel can be used to calculate the NPV. So let's say this is an investment of the project, which is $31,000 and 11% is the required rate of return. And we have different cash flows in different years. So the NPV, there is a function in Excel called NPV, which require you to input the value for rate and the cash flows. So the rate followed by all the cash flows and then subtract it from the cash outflow. Our cash outflow is subtracted from the NPV of the cash flows. So it is a difference between discounted cash inflow and discounted cash outflow. And with this equation, the value of NPV is positive. So NPV is greater than 0, so the project is accepted. Many financial calculators have the ability to compute a net present value for you. This may use the use of both a cash flow function and a net present value function, which is shown in the graph. Our main emphasis is on Excel application, but if you wanted to use the financial calculator, you can input the values for cash flows and F01 in the financial calculator, and then press the compute button of NPV to get the net present value. Does the discount rate have any effect on the present value? This is what we are trying to analyze with this project. So you have different discount rate or required rate of return, which is 8%, 13%, and 21%. So will those different discount rates have any impact on NPV? So let's try to analyze with the help of Excel. So this is the cash outflow, and we have the different discount rate of 8, 13, and 21. So when the discount rate is 8%, the NPV is positive, and 3590. At a discount rate of 13, the NPV is turning out to be negative. And at the discount rate of 21%, the NPV is more negative. So what it means that the different discount rates have a different impact on NPV. So at 8%, the NPV is positive. So if the required rate of return is 8% or the discount rate is 8%, the project should be accepted. At the discount rates of 13 and 21%, since the NPV is turning out to be negative, these should be rejected. Those projects should be rejected, or the project is rejected at the discount rate of 13% and 21%. So the project will increase the wealth by $3,590 at 8% rate of return, so should be accepted. Right, so the financial calculator we'll be using. The slide shows how to use the financial calculator to get the NPV values. Another method that is useful is the payback period method. So the payback period tells how long it will take for a project to generate sufficient cash to recover the initial investment in the project. And so it means that payback period is a period at which cash outflow and cash inflow are equal. So then if this is the payback period understanding, then which project should be accepted? So the rule is that the project having shortest payback period or the smallest payback period is accepted, because it is the project which quickly recovers the initial investment. Now let us try to estimate the payback period for this project. And the question is, should the project be accepted if the required payback period is 3 years? So if the question is, the project is to be accepted when the required payback period is 3 years. So you have a threshold payback period of 3 years. So you are comparing the project payback period with the standard payback period or the threshold payback period. So if the payback period of the project is less than 3 years, the project should be accepted. If it is greater than 3 years, project should be rejected. Right? And if you have multiple projects and they have different payback period, so the project which is having smallest payback period should be ranked first, and project with the longest payback period should be ranked last, and the project with the shortest payback period should be accepted. Now I'll show you how Excel can be used to calculate the payback period. So this payback period, the project has the initial investment of $215,000, and the cash flows that the project generates in each year till 5 years or through 5 years are given. So the first step is to find the cumulative cash flow. What is the total cash flow in each year? So the cash flow in first year is $34,200. Cash flow in second year is the cash flow in first year, and the cash flow that is generated by the project in second year. So the summation of these two will give you cash flow in the second year. So it is a cumulative cash flow. Likewise, you can find the cumulative cash flow for the year third, fourth, and fifth. Now you can see that the total of cash flows in third year is $156,500, and the total cash flow that the project generates, including all the previous cash flows in the fourth year, is $204,400. Excuse me. So it means that the cash outflow of the project is recovered somewhere in the year 4. So the payback period of the project is definitely after third year, because third year cash flow, cumulative cash flow, is $156,500, which is less than $215,000. right? So it is not in the third year. The fourth year, the total cumulative cash flow is 204,400. So the payback period, the cash outflow and inflow, so the total cash inflow are not equal. So the payback period is also not fourth year, but you can see the total cumulative cash inflow or cash flows in fifth year is 230,900, which is greater than cash outflow. It means that the project is able to recover its total cost of 215,000 somewhere in fifth year. So it means that the payback period will be after fourth year, but before the end of fifth year. So how to find this? It means that the payback period, we use this equation. After 4 years, so 4 plus, how much amount yet to be recovered is the difference between cash outflow and cash inflow. Total cumulative cash inflow in fourth year. So difference between the cash flows located in cell B13 and the cash flow in the year 4 divided by the balance is to be recovered from the cash flow of 26,500 in the fifth year. So it has to be divided by the cash inflow in the next year. So we have, once you use this equation, that will give you a payback period of 4.4 years. Since this payback period is greater than the required payback period of 3 years, the project shouldn't be accepted. So the project should not be accepted. Yeah, so another method which is also used to evaluate the various proposals are average accounting return. The average accounting return is equal to the average net income divided by the average book value. So what is the beginning book value of the project of an asset? What is the book value of those assets at the end of the 4 year? So the beginning value of the asset in our example is 115,000, and end of the year value of the book value of the project is 0. So the average is divided by 2. Average value of the net income for 4 years is the total net income addition of summation of income in each year divided by number of years will give you average net income. So it is 8.61. But the required rate of return is 9%. So it means that the project accounting rate of return or average accounting return is less than the required rate of return, so the project should be rejected. And Excel also can, we are just using this equation and we are plugging in those values in the equation to get the average accounting rate of return or average accounting return, which is 8.61. So the average of these two, so I use the equation, the function average divided by the average of the investment or the book value. So B21 plus 0, at the end of the year, the book value is 0. Divided by 2 is, we are dividing it to get the value of accounting return, which is 8.61. I hope this is clear. Another very important tool of capital budgeting is internal rate of return. So the internal rate of return, or IRR, is the discounting rate or the discount rate that makes the NPV or net present value of a project equal to 0. Calculating this rate manually is a trial and error process. Using a financial calculator, you input the cash flows and the calculator does the trial and error work for you. And if you use Excel, you use the function IRR in Excel that prints you directly the value of IRR. So let's consider this project with an initial cost. So this is a cash outflow of a project, and the project has a 3-year life, and each year the project generates the cash inflows of $18,800, $12,800, and $16,850 respectively. And what is the annual rate of return? And should the project be accepted or rejected, you'll have to compare the internal rate of return with the required rate of return. If the internal rate of return is more than the required rate of return, the project should be accepted. Now I'll show you how Excel can be used to calculate internal rate of return. The project having a cost of $39,500, and the cash inflows in each year are displayed here. So to get the internal rate of return, we use the function IRR, where you will be selecting all the cash flow that includes cash inflow and cash outflow together to find IRR. But make sure that cash outflow must be with the negative sign to classify as cash outflow. And then select all these cash flows with IRR function to get this internal rate of return, which is 11.22%, which is greater than the required rate of return. So the project will add value, and that will maximize wealth of the shareholders, and the project should be accepted. And now the crossover point is the point where you can accept, if the project is mutually exclusive, then either you can accept one but not both of these projects. So mutually exclusive project means if the acceptance of one project, you reject the other one. And from the reading of the textbook, you should realize that the crossover point is the discount rate at which the net present value of these two projects are equal. So it is a rate at which NPV of both the projects are equal. You should also know that one project is preferred at the discount rate below the crossover point, while the opposite project is preferred when the discount rate exceeds the crossover point. So the crossover point is a point at which NPV of project A and NPV of project B will be equal. So one project will be accepted at a discount rate below crossover point, and the other project will be accepted at a rate above or exceeds the crossover point. Of course, the decision rules remain same. You should never accept a project unless its NPV is positive. Okay, so now let's try to find out the crossover point of these two projects. This crossover point is the IRR of the difference in cash flows between project A and project B. What is IRR? IRR is a rate at which NPV is 0. So the difference of NPV between A and B will be 0, so the IRR at the difference will be 0. So it is IRR. If the NPV of the difference of cash flow is 0, means that you're finding the IRR of the difference in cash flows. So this IRR is the discount rate that equates the NPV value of each project as seen on the next slide. So the step to find their crossover point is to find the difference in cash flows of both the projects. So we have project A cash flows and project B cash flows, and the difference in cash flows is the difference between A minus B is 0 here, right? So that value is 0 minus the cash outflow project B, so it's 0. Likewise, you can find the difference, and what you have to do is you'll be using the same equation that we used before, but here you are finding the internal rate of return of the cash flow of the difference cash flow of difference value. Okay, so we are finding the internal rate of return of the difference in the cash flow. So the internal rate of return of the difference in cash flow. So we created a third column which shows the difference in cash flows value. So this internal rate of return using the same equation is 20.14%, which is greater than the required rate of return of 11%. So project should be accepted. Right, so it means that, you know, there is one project whose NPV is preferred. I mean, one project is preferred at a crossover rate below at a discount rate below the crossover point, while the opposite project is preferred when the discount rate exceeds the crossover point. So now we are trying to estimate NPV of both the projects A and B at a discount rate of 20.1%. That is what we estimated before, right? So at this discount rate of 20.14, which is we estimated of the difference in cash flows, the NPV of both the projects are equal. The question now is, which of the projects is a higher NPV at a discount rate of 11%? So this 20.14 is a crossover point, and we are trying to know what will be NPV of each project at 11%, or which project has the higher NPV at a discount rate of 11%. So we estimate NPV at 11%, and you can do it using Excel. The NPV of project A is more than project B. So the project B will have a higher NPV at a rate greater than 20.14% and should be selected. At a discount rate of 20.14, so since the 20.14% is a crossover point, you can select either of the project, right? Since the project A is higher NPV at a discount rate less than the crossover point, the project A should be accepted at a discount rate which is less than 20.14%, and project B will be accepted at a discount rate of higher than 20.14%. Right, so this is what the indication of the crossover point. So one project whose NPV is higher at a rate greater than crossover point, and one project having NPV higher than the higher at a rate less than crossover point. So in our example, project A having higher NPV at a rate lower than crossover point, so that project should be accepted at any discount rate which is less than 20.14, and project B should be accepted at any rate greater than a discount rate of 20.14%. Another very important technique of capital budgeting is modified internal rate of return, and this technique is used when the project has unconventional cash flows. What do you mean by unconventional cash flows? When the cash flows changes sign. When the cash flow changes sign, IRR becomes unreliable because you have multiple IRR problem. So when the cash flows are non-conventional, here is the case. When the project having cash flows for 3 years, so the first year the cash flow is positive, in second year cash flow is negative, and in third year cash flow is positive. So here, if you use IRR will be not reliable. The Excel spreadsheet will print only one IRR, but there are two IRR. The IRR when the cash flow is 67,000 and minus 21,000, and the other IRR is when the cash flow changes sign to 139,000. So there are two IRR, and that's why IRR is not that effective to evaluate the project. In that case, you'll be using modified internal rate of return. So that addresses the multiple rate of return problem by modifying the cash flows so they become conventional. And you can use the discount approach and compute the modified rate of return. Or you can use the reinvestment approach to calculate modified internal rate of return. So the reinvestment approach compounds all cash flows except the initial investment to the last year of project. Using this approach, the modified internal rate of return is 12.97. So what it has done, it has discounted all cash flows. So 67,000 is discounted with 12%, 21,000 is discounted with 12%, and the last year cash flows is 139,000. So in this reinvestment approach, except initial investment of 138,400, all cash flows are discounted, and you'll find the cash flow, total cash inflow, and then you calculate the internal rate of return, which is 12.97. When a modified rate of return use the discounting approach, you are discounting the negative cash flows. Okay, so this is in the year 0, so it's not discounted, and the 21,000 is in the year 2, so there are 2 years, which is discounted with the discount factor 1.12, and then you can find the internal rate of return. However, Excel can easily get you the value of modified internal rate of return of the project. So you have negative cash outflow. This is cash flow, which is negative, so it's an investment, and the cash inflow in each year. To find the MIR of the project, you use the function MIRR, where you will be selecting the cash flows, all the cash flows together, like you will be doing with IRR, followed by finance rate, which is required rate of return, and the reinvestment rate, that is also 9%. Using this equation, right, you can get the value of the modified internal rate of return is 11.89%. So this method is used when the cash flows are non-conventional. You cannot use IRR. You have to use modified internal rate of return to find the internal rate of return. So as you probably notice, the internal rate of return varies across somewhat depending on the method used to modify the cash flow, while the modification may not be perfect, because the problem with the modified internal rate of return is that you are not using original cash flows, you are modifying cash flows. So there's the criticism of the modified internal rate of return, but that is the method which tries to eliminate the problem associated with internal rate of return. So when the cash inflows are non-conventional, modified internal rate of return is more reliable than internal rate of return. Let us focus on the other method, which is profitability index. So the profitability index, or PI, tells you in today's dollar how much value the project is expected to create per dollar invested. So how much is the value that the project creating per dollar of investment? In our example, the profitability index is 1.08. It means for every $1 invested, this project is expected to return $1.08 in today's dollar value. projects are acceptable when the PI is equal to or greater than 1. Okay, so this project is accepted because PI is greater than 1. I'll show you in Excel to calculate, the profitability index. So the required rate of return is 14%. This is the cash outflow. So the equation for PI is is NPV divided by absolute value of cash flows, right? So we are considering the positive value of cash flows. So the NPV is the total PV of all the cash inflow. We are ignoring cash outflow because we are dividing the total PV of cash inflows with the cash outflow. So that will take into account the rate of return or the discount rate or the required return, followed by the cash inflow, close the bracket, which will print you the total PV of cash flows divided by cash outflows. And that will give you the profitability index of 1.08, which is greater than 1. So the project should be accepted. When the projects are mutually exclusive project. So does it matter whether you use NPV or IRR to evaluate the two mutually exclusive projects? If you evaluate these projects based on their IRRs, you will select project B because its IRR is a greater than project A. Then, in case of mutually exclusive project is an incorrect decision. Project A should be selected because it has the higher net present value. To avoid making wrong decisions, do not use IRR to evaluate mutually exclusive projects. So, when the projects are mutually exclusive, NPV is used. NPV is the most appropriate method to use to evaluate mutually exclusive project. So do you know the restrictions and disadvantage of NPV, IRR, and PI? What are the advantages of each method covered in this chapter? And before you complete this chapter, you should be able to list the advantages, disadvantages, and limitations of each of the investment criteria methods covered. You should also understand the accept or reject decisions rule for each method. And this will help you understand which method is more appropriate and which method is not. So what we have done to conclude this, we consider different methods of capital budgeting. So those methods falls into two categories: the method which considers time value of money and the methods which do not consider time value of money. So the method which considers time value of money that incorporate risk, and the method which does not take into account time value of money that ignores the risk. So those methods which consider time value of money are NPV, IRR, and modified internal rate of return. NPV is the best method. IRR suffers from the problem when the cash flows are non-conventional. It cannot be used, and it cannot rank a mutually exclusive project because IRR is a relative method. NPV can be used for mutually exclusive method. Modified internal rate of return tries to overcome the limitations of IRR by modifying the cash flows and to make it conventional. But since you are modifying cash flows, you are not taking the original cash flows, so it has its limitation. but it is better than internal rate of return when the cash flows are non-conventional. Accounting rate of return or average accounting return and payback period are the methods which do not take into account the time value of money, that ignores the risk. So those methods are not used because they ignore the risk. I hope this helps. Thank you.